Welcome to Market Brain. Today, we're diving deep into one of the most fascinating metrics in finance, volatility. Specifically, we're going to deconstruct the VIX, often called the market sphere gauge, and then explore how its powerful methodology can be applied far beyond its traditional home. Imagine being able to calculate a VIX-style index for any individual stock or ETF you're interested in. That's precisely what we're setting out to understand and build. So, what exactly is the VIX? At its core, the VIX, or Volatility Index, is a forward-looking measure of the expected volatility of the S&P 500 index over the next 30 days. Think of it as the market's collective prediction of how much the S&P 500 is likely to swing up or down in the near future. When the VIX is high, it signals that investors anticipate large price movements and uncertainty, often correlating with market fear. Conversely, a low VIX suggests a calmer, more stable market outlook. The VIX isn't just a number, it's a critical benchmark for market sentiment and a key tool for portfolio managers and traders. It's not directly traded like a stock, but rather derived from the prices of a wide range of S&P 500 options contracts. This makes it a unique indicator, as it reflects the implied volatility embedded within these options, rather than historical price movements. Understanding its calculation is crucial for anyone looking to truly grasp market dynamics and risk. Here's the catch: the VIX, as we know it, is specifically designed for the S&P 500. It tells us about the broad market, but what if you're interested in the implied volatility of a specific technology stock or an energy ETF? The standard VIX offers no direct insight into these individual assets. This limitation creates a significant gap for investors and quants who need precise volatility measures for their tailored portfolios and strategies. We need a way to generalize this powerful concept. This brings us to the central challenge: how do we calculate a VIX-style implied volatility for assets other than the S&P 500? Can we take the sophisticated methodology developed for the VIX and apply it to an individual stock, a commodity ETF, or even a specific sector index? The answer is a resounding yes, but it requires a deep dive into the mathematical underpinnings and practical considerations of options pricing and volatility derivation. This is where the real intellectual fun begins. To appreciate the modern VIX, it's helpful to understand its evolution. Volatility indices haven't always been as complex or as widely used as they are today. Early attempts to quantify market fear were much simpler, often relying on historical price movements or basic implied volatility from a few at-the-money options. The journey from these rudimentary measures to the sophisticated, model-free VIX we use today is a testament to financial innovation and mathematical rigor. The original VIX, introduced by the CBOE in 1993, was actually quite different from its current iteration. Known today as the VXO, it measured the implied volatility of S&P 100 index options, specifically focusing on 8 near-the-money options. This method relied on the Black-Scholes option pricing model to back out the implied volatility. While groundbreaking at the time, this approach had limitations, primarily its dependence on a specific pricing model and its narrow focus on at-the-money options. The modern VIX, launched in 2003, represented a significant leap forward. It shifted its focus to S&P 500 options and, crucially, adopted a model-free approach. Instead of relying on a specific option pricing model, it uses a weighted average of implied volatilities from a wide range of out-of-the-money S&P 500 call and put options. This innovation made the VIX more robust and less susceptible to the assumptions inherent in any single pricing model, truly reflecting the market's consensus view. The model-free aspect is critical. It means we don't need to assume a specific distribution for asset prices or a particular option pricing formula. Instead, the modern VIX methodology directly infers the expected variance by summing up the contributions of a continuum of out-of-the-money options. This elegant mathematical derivation, rooted in the work of Demeterfy, Derman, Kamal, and Zhou, allows us to extract the market's expectation of future volatility directly from the observed option prices across various strike prices. Our goal throughout this lecture series is to take this powerful model-free methodology and apply it to any optionable asset. Whether it's a popular tech stock, a specific sector ETF, or even a less liquid equity, the principles remain the same. By understanding the mathematical framework, we can build a robust system to calculate a VIX-style implied volatility for virtually anything with actively traded options. This opens up a world of possibilities for customized risk analysis and volatility trading strategies. In the upcoming sections, we'll systematically break down the exact mathematical formula for the modern VIX, explaining each component from first principles. We'll then walk through the practical steps of gathering the necessary options data, handling different maturities, and interpolating to achieve a consistent 30-day volatility measure. Finally, we'll explore how this can be implemented in code, allowing you to calculate these custom volatility indices for your own analysis. Get ready to unlock the secrets of implied volatility. Welcome back to Market Brain. In this section, we're diving deep into the fundamental motivation behind calculating a VIX-style volatility index for every optionable asset. We'll explore why this forward-looking measure is not just a theoretical curiosity, but a critical tool that underpins sophisticated financial analysis and decision-making in modern markets. Prepare to understand the why before we tackle the how. Let's start with the fundamental question: why bother calculating a VIX-style index for every optionable asset? Isn't historical volatility enough? The answer lies in the fundamental difference between looking backward and looking forward. Traditional measures, while useful, tell us what has happened. But in finance, what truly drives decisions is the market's collective expectation of what will happen. This forward-looking perspective is precisely what implied volatility captures, making it an indispensable tool for understanding market sentiment and potential future price movements. Consider the limitations of historical volatility. It's calculated directly from past price movements, often using simple standard deviation over a defined period. While straightforward, it inherently assumes that the future will resemble the past, which is a strong and often violated assumption in dynamic markets. Furthermore, historical volatility is a single number, reflecting only the magnitude of past price changes, without incorporating any information about the market's current perception of risk or future uncertainty. Now, contrast this with implied volatility. Instead of looking at past prices, implied volatility is extracted from the current market prices of options contracts. It represents the market's consensus forecast of an asset's future volatility over a specific period. This makes it inherently forward-looking. When option prices rise, implied volatility rises, signaling increased expected future uncertainty, even if the underlying asset hasn't moved much historically. This dynamic makes implied volatility a crucial real-time indicator of market sentiment. At its core, implied volatility, $sigma_implied, is the value of volatility that, when plugged into an option pricing model, yields the observed market price of that option. For a European call option, its price $C is a function of the underlying asset price $S_T, strike price $K, time to expiration $O, risk-free rate $R, and volatility $sigma. So, $C equals F, S_T, K, O, R, \sigma, $. Given $C, $S_T, $K, $O, and $R, we solve for $sigma. This is typically done numerically, as there's no closed-form solution for $sigma in most standard option pricing models. While the previous formula illustrates the concept, the VIX methodology employs a model-free approach. This is a critical distinction. Instead of relying on a specific model, which makes assumptions about asset price distributions and constant volatility, the model-free approach uses a weighted average of option prices across a range of strikes and maturities. This method is robust because it makes fewer assumptions, directly reflecting the market's collective view of future variance without being constrained by a particular theoretical framework. The advantages of this model-free methodology are significant. Firstly, it's less susceptible to model misspecification errors, as it doesn't assume a specific underlying process for asset prices. Secondly, it aggregates information from a broad spectrum of options, capturing a more comprehensive picture of market sentiment across different risk profiles and time horizons. This makes the resulting implied volatility measure more robust and representative of the overall market's expectation of future uncertainty for the underlying asset. The core idea behind the VIX-style model-free calculation is that the expected variance of an asset's return over a specific period can be approximated by a weighted sum of out-of-the-money option prices. Specifically, the variance $sigma$2 is proportional to the sum of the prices of out-of-the-money calls and puts, weighted by their respective strike prices. This elegant formula, derived from no arbitrage arguments, directly links the market's perception of future volatility to observable option prices, making it a powerful and theoretically sound measure. Why does this matter so profoundly in modern markets? In an era of rapid information flow and algorithmic trading, understanding market sentiment and expected risk is paramount. A VIX-style index for individual assets provides a real-time barometer of perceived risk, allowing investors and traders to gauge potential future price swings. This insight is invaluable for making informed decisions, whether it's for hedging portfolios, timing entries and exits, or constructing diversified strategies that account for asset-specific volatility expectations. For portfolio managers, a custom VIX for each asset allows for more granular risk management, enabling them to identify over- or underpriced volatility relative to their own models. Quantitative traders can use these measures to develop volatility-based trading strategies, such as selling options when implied volatility is high or buying when it's low. Even individual investors can gain a deeper understanding of the market's perception of risk for their holdings, moving beyond simple historical charts to a forward-looking view. By extending the VIX methodology to any optionable asset, we unlock a new dimension of market analysis. We move from a generic market fear gauge to a highly specific, asset-level indicator of expected uncertainty. This empowers us to build more sophisticated models, refine our risk assessments, and ultimately make more intelligent trading and investment decisions. In the upcoming sections, we will meticulously break down the exact mathematical steps and data requirements to implement this powerful framework. Welcome back to Market Brain. In our previous discussion, we explored the compelling reasons why a custom VIX-style index for individual assets is invaluable for modern portfolio managers and quantitative traders. We saw how it enables granular risk management and unlocks sophisticated volatility-based strategies. Now, it's time to transition from the why to the rigorous how, by dissecting the mathematical framework that underpins this powerful volatility measure. Understanding these core definitions is absolutely crucial for anyone looking to build, analyze, or even just comprehend VIX-style indices. We'll break down the key components, the underlying mathematical principles, and the specific market data points required to transform raw option prices into a meaningful, forward-looking volatility gauge. This section lays the bedrock for all subsequent calculations. At its core, any VIX-style index is derived from the intricate dance of a basket of options contracts. These contracts, each with its unique strike price and expiration date, are not just individual bets, they collectively form a rich tapestry of market sentiment. By observing their prices, we can infer the market's aggregated expectation of future volatility for the underlying asset. It's not a simple average, but a sophisticated, weighted aggregation that captures the full spectrum of potential price movements, from mild fluctuations to extreme events. The VIX doesn't directly measure volatility, instead, it fundamentally measures implied variance. Think of variance as the square of volatility, a more direct and additive measure of how spread out the potential outcomes are for an asset's price. This distinction is absolutely critical because the VIX methodology is ingeniously designed to replicate the payoff of a theoretical variance swap. By targeting variance as the primary quantity, the calculation becomes more robust and less susceptible to certain model assumptions, making variance the true fundamental building block. The true elegance of the VIX methodology lies in its model-free approach. Unlike traditional option pricing models that require assumptions about future volatility, the VIX extracts expected variance directly from observed option prices. It doesn't need to guess, it simply reads the market's collective mind. This is achieved by constructing a dynamic portfolio of options that precisely mimics the payoff of a variance swap, allowing us to infer the fair value of future variance without relying on complex theoretical models. Mathematically, the expected variance for a specific time to expiration, $T$, is approximated by summing the contributions of a carefully selected set of out-of-the-money options. For strikes below a designated reference point, we incorporate put options, while for strikes above it, we use call options. Each option's price is weighted by a factor inversely proportional to the square of its strike price and the interval between strikes, effectively discretizing and approximating a continuous integral over the probability distribution of future prices. Why specifically out-of-the-money options? These options are particularly sensitive to extreme price movements, often referred to as tail risks. They offer a clearer signal about the market's perception of potential large swings in the underlying asset's price, without being heavily influenced by the current spot price like at-the-money options. By focusing on OTM options, the VIX captures the market's fear or greed regarding significant deviations from the current price, providing a robust measure of expected volatility. A crucial initial step in the calculation is identifying the at-the-money strike, denoted as $K_0, which acts as the pivot point for selecting options. This is typically the strike price for which the absolute difference between the call and put option prices is minimized, or equivalently, the strike closest to the forward price of the underlying asset. This precisely identified strike helps delineate which options are considered OTM puts and which are OTM calls, ensuring the correct options are included in the variance summation. Beyond the raw option prices, two other critical market parameters are indispensable inputs to the VIX calculation. First, the risk-free interest rate, denoted as $R$, is used to discount future cash flows and account for the time value of money. This rate is typically derived from highly liquid, short-term government securities, reflecting a theoretical return with no credit risk. Second, the time to expiration, $T$, for each option series, expressed precisely in years, is crucial for correctly annualizing and scaling the variance measure. A key challenge arises because options rarely expire exactly 30 days in the future. To achieve a standardized 30-day implied volatility, the VIX calculation requires combining two option series, one with an expiration just under 30 days and another just over. Once the variances for these two series are calculated, a linear interpolation is performed. This process smoothly blends the two variance figures, allowing us to precisely estimate the implied variance for a hypothetical 30-day period, ensuring consistency across different market conditions. The result of this intricate calculation is a single, annualized, forward-looking measure of implied volatility. It's not a historical average, nor is it based on past price movements. Instead, it represents the market's collective consensus expectation of how much an asset's price will fluctuate over the next 30 calendar days, expressed as a percentage. This makes it an incredibly powerful and dynamic gauge of market sentiment and expected risk, providing a real-time snapshot of perceived uncertainty. To recap, we've established that VIX-style indices are meticulously constructed upon the model-free aggregation of out-of-the-money option prices. These prices are carefully weighted by factors involving their strike prices and strike intervals, allowing us to derive an expected variance for specific expiration periods. This expected variance is then annualized and its square root taken to yield the final volatility figure, which is finally interpolated to a standard 30-day horizon, providing a consistent, forward-looking market gauge. Welcome back to Market Brain. In our previous segment, we formalized the core definitions of implied volatility. Now, let's peel back another layer and explore the fundamental structural properties and mathematical axioms that make VIX-style calculations so powerful and robust. This isn't just about crunching numbers, it's about understanding the deep theoretical bedrock upon which these market-driven measures are built. Prepare to delve into the why behind the how. The VIX, or any VIX-style implied volatility index, isn't merely a statistical average. It's a sophisticated construct built upon a set of rigorous mathematical axioms and structural properties that ensure its consistency and interpretability. Think of these as the unshakable laws of physics for this financial metric. Understanding these foundational principles is crucial for anyone looking to truly grasp what implied volatility represents and how it functions as a forward-looking market barometer. One of the most critical axioms is the concept of model independence. Unlike traditional option pricing, which relies on specific models like Black-Scholes, the VIX methodology aims to derive volatility directly from market prices. This means the measure reflects the collective market consensus, rather than the assumptions of a single theoretical framework. It's like asking every participant their opinion directly, rather than predicting it based on one expert's formula. This property makes the VIX a truly market-driven indicator. This model independence is achieved through the elegant mathematical concept of static replication. We can construct a portfolio of out-of-the-money options that, when appropriately weighted and combined, synthetically replicates the payoff of a variance swap. The value of this portfolio, therefore, directly gives us the market's expectation of future variance, without needing to assume a specific stochastic process for the underlying asset. This is a powerful trick, allowing us to bypass model assumptions. Another fundamental axiom underpinning the VIX calculation is the assumption of risk-neutral pricing. In financial mathematics, this means that all assets are priced as if investors are indifferent to risk, and their expected returns are equal to the risk-free rate. While real-world investors are indeed risk-averse, this theoretical construct simplifies pricing and allows for consistent valuation across different derivatives. It's a mathematical convenience that ensures internal consistency and prevents arbitrage opportunities in a perfectly efficient market. Under the risk-neutral measure, the expected future value of an asset $S_T$ at time $T$, given its current price $S_0 and the risk-free rate $R$, is $S_0 RT$. This is a cornerstone of derivative pricing. For options, this means their prices reflect the expected payoff discounted at the risk-free rate, under a probability measure where the asset's drift is precisely the risk-free rate. This theoretical framework is essential for the VIX to aggregate option prices into a meaningful volatility measure. The VIX calculation also implicitly assumes a degree of continuity in option prices across different strike prices and maturities. This means that as you move from one strike price to an adjacent one, or from one maturity to another, the option prices should change smoothly, without sudden jumps or discontinuities. This assumption is vital for the interpolation and integration steps involved in constructing the variance swap replication portfolio, ensuring a well-behaved and calculable implied volatility surface. Imagine a three-dimensional surface where one axis represents strike prices, another represents time to expiration, and the vertical axis shows the implied volatility for each option. The continuity axiom suggests this surface should be smooth, without holes or sharp cliffs. This smooth surface allows us to effectively read the market's volatility expectations for various scenarios, even for strikes or maturities where options might not be actively traded, through robust interpolation techniques. While these axioms describe an idealized market, their practical application in the VIX calculation involves clever approximations. For instance, continuous trading is assumed, but options trade discretely. Similarly, bid-ask spreads exist, introducing friction. The VIX methodology navigates these real-world complexities by using specific interpolation techniques and carefully selecting the most liquid options, aiming to capture the theoretical ideal as closely as possible within market constraints. A practical requirement stemming from these axioms is the need for a sufficiently dense and liquid market for options across a range of strike prices and maturities. Without enough actively traded options, especially out-of-the-money contracts, the interpolation and integration steps become less reliable. This is why VIX-style indices are typically calculated for highly liquid underlying assets, ensuring that the market provides enough data points to accurately construct the implied variance and maintain the integrity of the calculation. Ultimately, the VIX methodology boils down to integrating across a continuum of out-of-the-money option prices to derive the market's expected variance. This integral, conceptually represented as $sigma_2 equals \frac 2 t \int underscore 0 \int t \frac p k k squared dk where $p k is the price of an option with strike $k is the mathematical heart of the calculation. It aggregates the information from all available options into a single, forward-looking volatility measure, reflecting the market's collective wisdom. These structural properties and axioms are not just theoretical niceties, they are the bedrock that gives the VIX its robustness and interpretability. They ensure that the resulting implied volatility is a consistent, market-driven measure, largely independent of specific models and reflective of collective market expectations. Understanding these foundations is key to appreciating the power and limitations of VIX-style indicators for any underlying asset, providing a deeper insight into market sentiment. Welcome back to Market Brain. In our previous discussions, we've explored the structural properties and axioms underpinning the VIX methodology, culminating in the integral form of expected variance. Now, we're going to elevate our understanding from practical application to theoretical rigor. This section, Advanced Theorems, Lemmas, and Proof Foundations, is where we unpack the sophisticated mathematical arguments that provide the absolute justification for why the VIX formula works. Prepare to dive deep into the elegant proofs that transform market observations into robust financial theory. We've seen the VIX formula, but why does it work? This section dives into the rigorous mathematical theorems that provide its foundation. It's not just an empirical observation, it's a profound consequence of financial theory. We'll explore the key lemmas and proofs that transform a simple integral into a robust measure of market expectations, moving from intuition to absolute certainty. Understanding these foundations is crucial for anyone looking to truly grasp the VIX methodology and its application to other assets, ensuring we build on solid mathematical ground. At the heart of all derivative pricing lies the concept of risk-neutral valuation. Imagine a hypothetical world where all investors are indifferent to risk. In such a world, the expected return on all assets is the risk-free rate, $R$. Under this crucial assumption, the fair price of any derivative today is simply the expected value of its future payoff, discounted back to the present at the risk-free rate, where the expectation is taken under this special risk-neutral probability measure, denoted by $Q. This framework allows us to price options consistently without needing to estimate individual risk preferences. One of the most elegant and powerful results in financial mathematics is the Breeden-Litzenberger theorem. It states that if we have a continuum of call option prices across all strike prices for a given maturity, we can directly infer the market's risk-neutral probability density function for the underlying asset's price at expiration. Think of it like this: each option price contains a tiny piece of information about the market's belief regarding future price outcomes. By observing how these prices change with strike, we can reconstruct the entire probability distribution, a truly remarkable feat. Formally, the Breeden-Litzenberger theorem states that the second derivative of the European call option price, $C, KT, with respect to its strike price $K, scaled by the discount factor $E, yields the risk-neutral probability density function $Q, S_T equals K, for the underlying asset's price $S_T at time $T. This is a profound result because it means we don't need to assume a probability distribution, the market reveals it through option prices. This theorem is a cornerstone for model-free implied volatility calculations like VIX, providing a direct, observable link to market expectations. The beauty of the Breeden-Litzenberger theorem is that it allows us to move beyond specific pricing models like Black-Scholes. We don't need to assume a log-normal distribution or any other specific process for the underlying asset. The market's collective wisdom, embedded in option prices, directly provides the risk-neutral probability distribution. Once we have this distribution, calculating its expected variance becomes a straightforward mathematical exercise, leading us directly to the model-free implied volatility concept that underpins the VIX, making it incredibly robust and versatile. To understand how option prices relate to variance, we need to introduce a theoretical instrument called a log contract or, more practically, the payoff of a variance swap. A variance swap is a derivative that pays out the realized variance of an underlying asset over a period. Its theoretical fair value is the market's expectation of future variance. The key insight is that a portfolio of options can replicate a payoff proportional to the logarithm of the asset price at expiration, $ln s_t/s_0, which is directly related to variance. This connection is fundamental to the VIX methodology. This brings us to the ingenious Karmadun replication strategy. They demonstrated that a static portfolio consisting of out-of-the-money European call and put options, continuously weighted by the inverse square of their strike prices, can perfectly replicate the payoff of a log contract. This means that the fair value of this replicating portfolio is the market's expected variance. This groundbreaking result provides the direct link between observable option prices and the unobservable expected variance, forming the mathematical bedrock of the VIX methodology and allowing for its model-free construction. Combining the insights from Breeden-Litzenberger and Karmadun, we arrive at the celebrated model-free variance formula. This integral represents the fair value of a variance swap, derived by summing the contributions of an infinite continuum of out-of-the-money put options, for strikes below the forward price $F_0, and call options, for strikes above $F_0, each weighted by the inverse square of its strike price. This formula is the direct mathematical expression of how the market's expected variance is extracted from observable option prices, without relying on any specific model assumptions, making it incredibly powerful. The elegance of these theorems lies in their model-free nature. By relying on risk-neutral pricing, the Breeden-Litzenberger theorem, and the Karmadun replication strategy, the VIX methodology provides a robust and theoretically sound measure of expected volatility. It doesn't assume a specific underlying price distribution, making it adaptable to various market conditions and assets. This theoretical foundation ensures that the VIX, and similar implied volatility measures, accurately reflect the market's consensus view on future price fluctuations, providing invaluable insights for traders and analysts alike. To recap, the VIX calculation, and indeed any robust model-free implied volatility measure, stands on three critical theoretical pillars. First, risk-neutral pricing ensures a consistent valuation framework for derivatives. Second, the Breeden-Litzenberger theorem provides the mechanism to extract the market's risk-neutral probability distribution directly from observable option prices. And finally, the Karmadun replication strategy shows how a portfolio of options can replicate a variance swap, thus linking option prices directly to expected variance. Together, these theorems provide the rigorous proof foundations for the VIX, making it a truly sophisticated instrument. With these advanced theorems and lemmas firmly established, we now have a complete theoretical justification for the VIX methodology. This isn't just abstract math, it's the bedrock that allows us to confidently calculate implied volatility for any optionable asset. Understanding these foundations empowers us to not only use the VIX but also to adapt its principles to new instruments and market scenarios, ensuring our analysis remains mathematically sound and reflective of true market expectations. This deep dive into theory is essential for mastering the practical application of implied volatility. Welcome back, Market Brains. In our last session, we laid the theoretical groundwork for model-free implied volatility, specifically the VIX-style calculation. We discussed the critical roles of risk-neutral pricing and the Breeden-Litzenberger theorem. Now, it's time to translate those powerful abstract concepts into the concrete mathematical formulas that underpin the VIX methodology. This section, part A of our derivations, will walk you through the core integral representation of variance and its initial transformation into a practical, summable form. Our ultimate goal is to quantify the market's expectation of future volatility, expressed as variance. In a risk-neutral world, this expectation, denoted E_Q, becomes directly observable through option prices. We're not just looking for historical variance, but the forward-looking, implied variance of the underlying asset's returns over a specific period, typically 30 days. This measure captures the market's collective sentiment about future price swings, stripped of any risk premium. Building upon the Breeden-Litzenberger theorem, which links option prices to the risk-neutral probability density function, we can express the expected variance of the underlying asset's returns as an integral. This elegant formula shows that if we had a continuous spectrum of call and put options across all strike prices, their prices, weighted by the inverse square of their strikes, would directly yield the variance. It's a powerful theoretical bridge from observable market prices to an unobservable future quantity. While the theoretical integral uses all options, practical VIX-style calculations focus exclusively on out-of-the-money, or OTM, options. Why this selectivity? Deep-in-the-money options primarily trade based on their intrinsic value, offering little insight into future volatility. OTM options, however, are pure volatility plays, their prices are highly sensitive to changes in implied volatility. Furthermore, OTM options typically exhibit better liquidity and tighter bid-ask spreads, making them more reliable for price discovery in the market. A crucial first step in the VIX methodology is determining the forward price, F, of the underlying asset for the chosen expiration. This isn't simply the current spot price. Instead, it's derived from option prices themselves. We identify the strike price, K_0, where the absolute difference between the call and put option prices for that strike is minimized. Using this K_0, the forward price F is then calculated by adding the time value difference between the call and put at K_0, discounted back to present value, to K_0 itself. With the forward price F established, we can now present the core integral form of the VIX-style variance calculation. Notice how it splits the integral. OTM put options are used for strikes below F, and OTM call options for strikes above F. This precisely aligns with our focus on OTM options. The term E_RT discounts the future expected variance back to the present, and the final term is a crucial adjustment to ensure the variance calculation is accurate around the forward price, F, relative to the chosen K_0 strike. In a perfect theoretical world, we'd have options for every conceivable strike price, allowing us to compute the integral continuously. However, real-world markets only offer options at discrete, predefined strike intervals. This practical limitation means we cannot perform a true continuous integration. Instead, we must approximate the integral using a summation over the available, discrete strike prices. This transformation is a necessary step to bridge the gap between elegant theory and practical application. Here it is, the discretized version of the VIX-style variance formula. The integral sign has been replaced by a summation symbol, sum. Each term in the sum now represents the contribution of a specific out-of-the-money option, Q, K_I, at strike K_I. The key new element is delta K_I, which acts as a weighting factor, representing the width of the interval assigned to each strike. This formula is the workhorse of model-free implied volatility calculations, directly applicable to market data. Let's delve into the crucial weighting factor, delta K_I. For any given strike K_I, delta K_I is calculated as half the difference between the adjacent strike prices, K_I+1, and K_I1. Essentially, it assigns an interval around each strike, ensuring that each option contributes proportionally to the total variance. For the lowest and highest strikes in this series, delta K is typically calculated as the difference between the strike and its only adjacent strike, or a special rule is applied to ensure proper weighting at the boundaries. Finally, let's examine that seemingly small but critical adjustment term at the end of the variance formula. This term, -1/t, f/K_0, 1, caret 2, serves as a correction. It accounts for the difference between the calculated forward price, F, and the specific strike K_0 that was used to determine F. This adjustment ensures that the variance calculation is properly centered around the forward price, providing a more accurate and robust measure of implied volatility, consistent with the theoretical underpinnings. We've now derived the core discretized formula for VIX-style variance, understanding each of its components. But the journey isn't over. In Part B of our mathematical derivations, we'll dive into the practical nuances, how to meticulously select the appropriate out-of-the-money options, handle missing strikes through interpolation, and combine the variance measures from different expiration dates to arrive at the final, annualized 30-day implied volatility. Stay tuned for the next step in unraveling market brain. We've now derived the core discretized formula for VIX-style variance, understanding each of its components. But the journey isn't over. In Part B of our mathematical derivations, we'll dive into the practical nuances, how to meticulously select the appropriate out-of-the-money options, handle missing strikes through interpolation, and combine the variance measures from different expiration dates to arrive at the final, annualized 30-day implied volatility. Stay tuned for the next step in unraveling market brain. Welcome back to Market Brain. In our previous segment, we meticulously derived the core discretized formula for VIX-style variance, breaking down each component into its fundamental mathematical principles. We established the theoretical framework, understanding how to sum up the contributions of individual options to estimate future volatility. But as any seasoned quant knows, the real world of financial data rarely aligns perfectly with pristine theoretical models. Data is often messy, incomplete, or requires specific handling rules to maintain consistency and accuracy. This section, Part B of our mathematical derivations, tackles precisely these practical nuances, ensuring our VIX-style calculation is robust and applicable to real market conditions. Recall our foundational VIX-style variance formula, which aggregates the weighted contributions of out-of-the-money options across a range of strike prices. The essence of this formula lies in its ability to capture the market's expectation of future price movements by observing the implied volatility embedded in option prices. However, the theoretical summation assumes a continuous spectrum of available options at every conceivable strike. In reality, options are traded at discrete strike intervals, and not all strikes are actively quoted or even available. This discrepancy necessitates a set of practical rules to bridge the gap between theory and application, ensuring our calculation remains both accurate and consistent. The first critical adjustment involves selecting the appropriate options. The VIX methodology specifically uses out-of-the-money options because they are generally more sensitive to changes in implied volatility and provide a broader view of the market's risk perception across different price scenarios. In-the-money options, conversely, behave more like the underlying asset itself, making them less ideal for isolating pure volatility expectations. Therefore, a strict rule for selecting only out-of-the-money calls and puts is paramount to align with the VIX's design philosophy and capture the true market sentiment regarding future price dispersion. The selection rule for out-of-the-money options is straightforward. For call options, we only consider those with a strike price $K greater than the forward price $F. Conversely, for put options, we only include those with a strike price $K less than the forward price $F. This ensures that we are always looking at options that would expire worthless if the underlying asset's price remained at the forward level. The forward price $F itself is typically derived from the prices of near-the-money options and the risk-free rate, representing the market's expectation of the asset's price at expiration. But what about options that are exactly at the money, meaning their strike price $K is equal to the forward price $F? The VIX methodology specifies a unique treatment for these. Typically, the first strike price below the forward price, $K_F, is used to define the boundary. All put options with strikes less than or equal to $K_F are included, and all call options with strikes greater than or equal to $K_F are included. This ensures a comprehensive coverage of the volatility surface while maintaining the out-of-the-money focus. This specific rule helps to avoid double counting or omitting crucial information around the forward price. Now, let's address the issue of missing strike prices. In a perfect world, we'd have options quoted for every infinitesimal strike increment. In reality, options are listed at discrete intervals, and sometimes, specific strikes might not be actively traded or quoted. To maintain the continuity required by the VIX formula's integral approximation, we must interpolate the implied volatilities or option prices for these missing strikes. The most common and straightforward method for this is linear interpolation, which assumes a direct proportional relationship between known data points. This allows us to estimate the values for unobserved strikes based on their neighbors. Linear interpolation is a simple yet effective technique. Imagine you have two known points on a graph, say the price of an option at strike $K_A and another at strike $K_B. If you need to estimate the price for a strike $K_A that falls exactly between $K_A and $K_B, linear interpolation draws a straight line connecting the two known points and picks the value on that line corresponding to $K_A. While more sophisticated interpolation methods exist, linear interpolation offers a good balance of simplicity and accuracy for this application, especially when dealing with relatively dense strike intervals. It prevents abrupt jumps and ensures a smooth transition across the volatility surface. While linear interpolation is widely used, it's important to acknowledge that other methods exist, each with its own trade-offs. For instance, cubic spline interpolation can provide a smoother curve by fitting polynomial segments between data points, ensuring continuity in both the function and its first and second derivatives. However, it introduces more complexity and can sometimes lead to undesirable oscillations if not handled carefully. For the purpose of VIX-style calculations, where the emphasis is on robustness and replicability across various assets, linear interpolation strikes an optimal balance, providing sufficient accuracy without overcomplicating the process. It's a pragmatic choice for a standardized index. A crucial step before applying the interpolation and summation is to determine the forward price, $F. This is not simply the current spot price of the underlying asset. Instead, it's derived from the options market itself, specifically using the prices of out-of-the-money calls and puts. The forward price is the strike $K at which the absolute difference between the call price and the put price, both with the same strike and expiration, is minimized. More formally, it's the strike $K that satisfies the condition where the call price $C, minus the put price $P, is approximately equal to the present value of the difference between the forward price and the strike, discounted at the risk-free rate. Once the forward price $F is established, we identify the first strike below the forward price, denoted as $K_F. This strike is pivotal because it acts as the dividing line for our out-of-the-money options selection. All put options with strike prices less than or equal to $K_F are included, and all call options with strike prices greater than or equal to $K_F are included. This ensures that we are consistently selecting options that are truly out of the money relative to the market's forward expectation, providing a robust and unbiased input for our variance calculation. This meticulous selection process is fundamental to replicating the VIX methodology accurately. To summarize, Part B of our mathematical derivations has equipped us with the practical tools to navigate the complexities of real-world options data. We've learned how to rigorously select out-of-the-money options based on the forward price, ensuring our inputs align with the VIX's design. We've also addressed the challenge of discrete and missing strike prices by employing linear interpolation, a robust method for estimating unobserved data points. These adjustments are not mere technicalities, they are fundamental to building a VIX-style volatility index that is both mathematically sound and practically implementable across various underlying assets. The journey continues as we move towards integrating these components. With these practical adjustments in hand, we are now much closer to a fully functional VIX-style variance calculation. We've moved beyond the theoretical ideal and embraced the realities of market data. The next crucial step in our journey will involve combining the variance contributions from options across different expiration dates. This process, known as time weighting, is essential for creating a single, standardized 30-day implied volatility measure, just like the official VIX. Stay tuned as we delve into the intricacies of time weighting and finalize our comprehensive VIX-style methodology. Welcome back to Market Brain. In our previous sections, we meticulously built the mathematical foundations for understanding implied volatility, culminating in the rigorous selection of options data. Now, it's time to bridge the gap. We're moving from the pristine world of abstract equations to the often messy reality of quantitative finance, where theory meets market data. Our objective is clear: to take the elegant mathematical models we've derived and show precisely how they are implemented using actual options market data. This isn't just about plugging numbers into a formula, it's about understanding the assumptions, the approximations, and the practical decisions that transform theoretical constructs into tangible financial metrics. It's where the quant in quant finance truly comes alive. Recall our core theoretical components: the concept of risk-neutral pricing, the fundamental relationship between option prices and expected future variance, and the integral representation of variance. These are the bedrock principles. In an ideal world, we'd have a continuous spectrum of options at every strike and maturity, allowing for perfect integration. But the real world provides discrete data points. At the heart of many option pricing models lies a function that relates option price to underlying asset price, strike, time to maturity, risk-free rate, and crucially, volatility. For a European call option, this can be abstractly represented as $C equals F, S, K, T, R, \sigma, $. Here, $sigma $ is the implied volatility we seek. This formula is our theoretical lens through which we view market prices. However, real-world data presents several challenges. Options trade at discrete strikes and maturities, not continuously. There are bid-ask spreads, liquidity issues, and potential data errors. Our mathematical models often assume frictionless markets and continuous trading. The art of quantitative finance lies in skillfully navigating these discrepancies, making informed choices to approximate theoretical ideals with practical market observations. Consider the contrast: theoretically, we might assume a single, perfectly observed risk-free rate. In practice, we use observable rates like treasury yields, interpolated for specific maturities. Similarly, the theoretical forward price is a continuous concept, but in practice, it's derived from the closest out-of-the-money options or futures prices, requiring careful calculation and selection to match our model's assumptions. The VIX methodology approximates the continuous integral of out-of-the-money option prices by summing contributions from discrete options. The core idea is that the variance $sigma $2 can be estimated by a weighted sum of option prices across different strikes. Specifically, for a given maturity, the variance contribution from each option is proportional to its price divided by the square of its strike price, scaled by the strike interval. This summation requires careful data handling. We must select out-of-the-money options, identify the two options closest to the forward price to determine the at-the-money strike, and then calculate the $$K for each option. Furthermore, we must use the midpoint of the bid-ask spread for option prices to mitigate liquidity effects and ensure a fair representation of market consensus. The iterative process of refining our models with real data is crucial. We start with a theoretical framework, collect market data, apply our selection criteria, and then compute the desired metric. If the results don't align with expectations or exhibit inconsistencies, we revisit our assumptions, data filters, or even the underlying mathematical approximations. This feedback loop is fundamental to building robust quantitative tools. The final VIX-style variance for a single maturity is a weighted average of these individual option contributions. After summing up the terms for calls and puts, we then adjust for the forward price and the risk-free rate. The formula for the variance $sigma $2 for a specific time to expiration $T is given by $sigma $2 equals \frac 2 t \sum underscore I \frac \delta k underscore I k underscore I caret 2 e caret art q k underscore I \frac 1 t \left \frac f k underscore 0 1 \right caret $2. This combines the discrete option data into a single variance measure. This mapping from abstract math to quantitative finance constructs is not merely an academic exercise, it's the engine that drives modern financial analysis and trading strategies. By understanding how theoretical concepts are operationalized, we gain profound insights into market behavior and the dynamics of implied volatility. It empowers us to build our own tools and critically evaluate existing ones. To summarize, this section has illuminated the crucial steps in translating mathematical theory into practical quantitative finance. We've seen how discrete market data is used to approximate continuous theoretical integrals, and the practical considerations involved in selecting and processing options data. This understanding is vital for anyone looking to build or analyze VIX-style implied volatility measures for any underlying asset. Welcome to a crucial segment where we bridge the gap between theoretical models and practical application. We've delved deep into the mechanics of implied volatility, particularly in the context of the VIX. Now, it's time to expand our horizons. This section will demonstrate how the powerful mathematical framework used for the VIX can be generalized and applied to virtually any financial asset with an active options market, providing a versatile tool for quantitative analysis. The true strength of robust mathematical frameworks lies in their generalizability. While the VIX is a specific measure for the S&P 500, its underlying methodology is far more universal. Imagine being able to quantify the market's 30-day forward-looking expectation of volatility for an individual stock, an exchange-traded fund, or even a commodity. This section explores precisely how we can adapt the rigorous VIX calculation to transform a specialized index into a universal analytical tool, applicable across a broad spectrum of financial instruments. Why is this generalization so profoundly important for financial analysis? Firstly, it enables highly granular, asset-specific risk assessment, moving beyond broad market sentiment to pinpoint individual instrument risk. Secondly, it facilitates powerful comparative analysis across diverse asset classes, revealing relative perceived risks and opportunities. Thirdly, it empowers the development of sophisticated trading strategies that capitalize on discrepancies between an asset's implied volatility and its historical volatility or the broader market's expectations. This granular insight is invaluable for precise portfolio management and effective risk mitigation. At its core, implied volatility represents the market's collective expectation of an asset's future price fluctuations, directly derived from the prices of its options. Recall that an option pricing model, such as the Black-Scholes formula, establishes a relationship between an option's theoretical price and several inputs, including the underlying asset's volatility. When we observe an option's actual market price, we can effectively reverse engineer this formula to solve for the unique volatility parameter, $sigma implied $, that makes the model price match the observed market price. This is the fundamental principle we leverage. The VIX specifically targets the S&P 500 index, utilizing a carefully selected basket of out-of-the-money options to construct a 30-day forward-looking measure of implied volatility. When we generalize this concept, we are essentially creating a VIX-style index for any individual optionable asset. The primary difference lies in the specific underlying asset and the particular options chosen from its chain, but the robust mathematical framework for aggregating these option prices into a single, comprehensive volatility measure remains remarkably consistent. It's about applying the same powerful recipe to different ingredients. Imagine plotting this generalized implied volatility for an individual asset over time. Unlike the broad VIX, which often correlates with overall market fear, an asset-specific implied volatility might exhibit unique spikes due to company-specific news, anticipated earnings announcements, or industry-specific regulatory changes. This hypothetical chart would vividly illustrate how the market's perception of risk for that particular asset evolves, offering a granular, focused view that a general market index simply cannot provide. It allows us to pinpoint exactly where and when the market anticipates turbulence for a specific instrument. The core calculation for a generic asset closely mirrors the VIX methodology by focusing on a broad spectrum of out-of-the-money call and put options across various strike prices and typically 2 near-term expiry dates. The objective is to capture a comprehensive range of market expectations for future price movements. We then employ a sophisticated interpolation technique between the volatility measures derived from these 2 expiry dates to arrive at a standardized 30-day forward-looking volatility. This meticulous process ensures consistency and comparability, regardless of the specific option chain available for the asset. To successfully implement this for any generic asset, a clear, systematic approach is essential. First, identify all actively traded options for the underlying asset with suitable expiry dates. Second, meticulously select out-of-the-money options, typically calls above the forward price and puts below it, ensuring sufficient liquidity for accurate pricing. Third, calculate the implied volatility for each selected option using an appropriate pricing model. Fourth, aggregate these individual implied volatilities using a weighted average, often involving interpolation between two expiry cycles to achieve a precise 30-day measure. This systematic process ensures a robust and consistent volatility estimate. The true power of this generalized approach lies in its unparalleled versatility. It empowers quantitative analysts and traders to construct custom volatility indices for virtually any asset that boasts an active and liquid options market. This capability unlocks new avenues for developing sophisticated strategies, such as relative value trades between an asset's implied volatility and its sector's implied volatility, or integrating it as a dynamic input for advanced risk management models. It transforms raw market data into highly actionable insights, providing a significantly deeper understanding of perceived risk and opportunity. Consider the sheer breadth of optionable assets available across global markets. If we can consistently apply a VIX-style calculation to even a significant fraction of these, we unlock an expansive landscape of new analytical possibilities. This isn't merely about generating a single number, it's about creating a scalable framework capable of producing thousands of unique, forward-looking risk indicators, each meticulously tailored to a specific financial instrument. The potential for profoundly enhanced market understanding and more precise, granular risk management is immense, fundamentally reshaping how we perceive and strategically respond to market dynamics. Ultimately, the generalized implied variance, often denoted as $sigma_2 30-day $, represents a carefully constructed weighted average of the squared implied volatilities derived from a continuum of options. The sophisticated weighting scheme ensures that options closer to the money and those exhibiting higher liquidity contribute more significantly to the final measure, while still effectively capturing the crucial tail risk implied by out-of-the-money options. This continuous aggregation across strike prices and precise interpolation across time horizons provides a robust and comprehensive measure of the market's collective expectation of future price dispersion for the underlying asset. By mastering this generic application of implied volatility, you gain a profoundly powerful analytical tool that transcends the limitations of specific market indices. You are no longer confined to the S&P 500 sphere gauge. Instead, you can construct a similar, highly relevant gauge for any asset where options actively trade. This invaluable ability to derive asset-specific implied volatility is a cornerstone of modern quantitative finance, enabling more nuanced risk assessment, the development of more targeted hedging strategies, and ultimately, a more profound understanding of the market's collective wisdom regarding future uncertainty. It's about empowering your analytical capabilities to their fullest potential. Welcome back to Market Brain. We've explored the theoretical underpinnings of generalized implied variance, understanding it as a sophisticated weighted average of option-derived volatilities. But how do we actually compute this in the real world, where options are discrete instruments, not a continuous spectrum? This section demystifies the abstract numerical implementation, walking through the iterative process required to bring these complex mathematical constructs to life. The VIX methodology, and by extension, our generalized implied variance, is fundamentally defined as an integral over a continuum of out-of-the-money options. However, financial markets don't offer an infinite continuum. They provide a discrete set of options with specific strike prices and expiration dates. This presents our first computational challenge: how do we approximate a continuous integral using only discrete data points? The solution lies in numerical integration techniques, specifically approximating the integral as a summation. Instead of integrating from 0 to infinity, we sum across the available strike prices for a given expiration. Each option's contribution is weighted based on its position relative to adjacent strikes, effectively forming a series of trapezoids under the implied volatility curve. This transformation from integral to sum is the cornerstone of practical implementation. To perform this calculation, we need several key pieces of data for each available option contract. This includes the strike price, $K_I$, the bid and ask prices from which we derive a mid price, and the time to expiration, $T$. Additionally, we require the risk-free interest rate, $R$, for discounting purposes, and crucially, the forward price of the underlying asset, $F$, which acts as a pivot point for our calculations. A critical first step is determining the forward price, $F$, for each expiration. This is typically derived from the options market itself, often by finding the strike $K$ where the absolute difference between the call and put prices is minimized. Once $F$ is established, we identify the at-the-money strike, $K_0 as the strike price immediately below $F$. This $K_0 serves as the anchor point for our summation, ensuring we correctly capture out-of-the-money options. Imagine an options chain, a list of available strikes. For each strike, we have a call and a put price. Our algorithm systematically navigates this chain. We start by identifying the $K_0 strike, which is the closest strike below the calculated forward price $F$. From $K_0, we then consider out-of-the-money calls with strikes greater than $K_0 and out-of-the-money puts with strikes less than $K_0. This careful selection ensures we adhere to the VIX methodology's focus on capturing tail risk. For each selected option, we calculate its contribution to the overall variance. The weighting factor, $delta K_I, is half the difference between the adjacent strike prices. For the lowest and highest strikes, it's simply the difference between the strike and its single neighbor. The formula then sums these weighted contributions, along with a special term for the at-the-money option, to yield the total variance for that specific expiration period. The process involves several key steps for each relevant expiration. First, we filter for options that meet liquidity criteria and are within a reasonable range of the forward price. Then, we calculate the forward price $F$ and identify the K_0 strike. Next, we meticulously select out-of-the-money options and the specific at-the-money put and call for the K_0 strike. Finally, we apply the summation formula to compute the variance for that specific time to expiration. Once we have calculated the variance for the two nearest term expirations that bracket the 30-day mark, say $sigma_2_ T_1 and $sigma_2_ T_2, we perform a linear interpolation. This step is crucial because we need a variance measure for a precise 30-day period, not just for the available expiration dates. The interpolation formula blends the two variances based on their respective times to expiration, yielding our target 30-day implied variance, $sigma_2_ 30-day, $. While the theoretical framework is elegant, practical implementation introduces complexities. We must contend with illiquid options, bid-ask spreads that can distort mid-prices, and the need for robust data cleaning. The algorithm must be resilient to missing data points or unusual market conditions. This contrasts with the theoretical ideal of a perfectly liquid market with continuous, unambiguous option prices, highlighting the gap between mathematical models and real-world data. The beauty of this abstract numerical implementation is its generalizability. While we've discussed it in the context of a VIX-style index, the underlying principles apply to any asset with a sufficiently liquid options market. This iterative process of data collection, forward price determination, variance calculation for multiple expiries, and final interpolation forms a powerful, adaptable algorithm. It allows us to quantify market expectations of future volatility for a wide array of financial instruments. In summary, the abstract algorithm involves collecting option data, calculating forward prices for relevant expiries, determining the at-the-money strike $K_0, computing the variance for each of the two nearest expiries using the weighted summation, and finally, linearly interpolating these variances to arrive at the 30-day implied variance. This structured approach ensures a consistent and mathematically sound estimation of future volatility, bridging the gap between theory and practical application. As we delve deeper into the mechanics of VIX-style implied volatility, it's crucial to address some common misunderstandings and potential pitfalls. This metric, while incredibly powerful, is often misinterpreted or misapplied. Understanding its limitations and the specific conditions under which it operates is just as important as grasping its core calculation. We'll explore the subtle complexities that can arise, from data sparsity to theoretical assumptions, ensuring a more robust and accurate application of this framework. One of the most pervasive misconceptions is viewing a VIX-style index as a crystal ball for market direction. Many believe a high VIX implies an imminent market crash, or a low VIX signals smooth sailing. However, this is fundamentally incorrect. The index is purely a measure of the market's expectation of future price fluctuations, or volatility, over a specific period. It tells us nothing about whether those fluctuations will be upwards or downwards. Mathematically, the VIX-style index is derived from a model-free calculation of the market's expectation of future variance. It aggregates the implied volatilities across a wide range of out-of-the-money options. The formula essentially sums weighted option prices, where each option contributes to the overall expected variance. There is no component in this calculation that directly predicts the future price level of the underlying asset, only the magnitude of its potential movement. A significant practical challenge arises when applying this methodology to assets with illiquid options markets. Unlike major indices, many individual stocks or ETFs have options that trade infrequently or with very wide bid-ask spreads. This sparsity of reliable data points can severely compromise the accuracy of the interpolation and extrapolation steps required to construct the continuous volatility curve. Stale prices, where the last traded price doesn't reflect current market conditions, further complicate the calculation, leading to potentially misleading implied volatility figures. Recall that the VIX methodology requires a continuum of option prices across a range of strikes. When actual market data is sparse, we rely heavily on interpolation techniques to estimate prices for strikes where no active quotes exist. If the observed option prices are few and far between, or if they are not representative of true market sentiment due to illiquidity, the interpolated values will be less reliable. This directly impacts the accuracy of the integral approximation for expected variance, introducing noise and potential bias into the final index value. Another common misconception is labeling the VIX-style index as a fear index. While it often rises during periods of market stress, this is a correlation, not a direct causal link or an emotional measurement. The term fear is an anthropomorphic interpretation of a purely quantitative metric. It's more accurate to say that during times of uncertainty, market participants demand higher premiums for options, reflecting a greater expectation of price swings, which then translates into a higher implied volatility index. To be precise, a VIX-style index quantifies the market's expectation of the future realized variance of the underlying asset's returns over a specific time horizon. It's an objective, model-free measure because it's directly calculated from the prices of actively traded options. These prices are the collective consensus of market participants, reflecting their aggregate expectations. Therefore, while it might correlate with sentiment, its fundamental nature is purely mathematical and statistical, not psychological. The theoretical VIX formula involves an integral over a continuum of strike prices. However, in practice, we only have discrete option contracts available at specific strike intervals. This means we must approximate an integral using a summation of discrete terms. The accuracy of this approximation heavily depends on the density and uniformity of available strike prices. If strikes are widely spaced, or if the spacing is irregular, the discrete summation can introduce significant approximation errors, deviating from the theoretical continuous integral. The core of the VIX calculation involves approximating an integral of option prices weighted by the inverse square of their strike prices. When we replace this continuous integral with a discrete sum, each term in the sum represents an interval $delta K_I$. If these intervals are not chosen carefully, or if the market data doesn't provide sufficient granularity, the approximation can be poor. Robust interpolation methods are critical here to create a smooth, continuous curve from discrete data points before performing the summation, minimizing the error introduced by this discretization. Another critical edge case, often overlooked, involves the treatment of dividends. For assets that pay dividends, the forward price, which is a key input for determining the at-the-money strike and for the overall calculation, must be adjusted. Ignoring expected dividends between the current date and the option's expiration date will lead to an incorrect forward price. This, in turn, biases the entire implied volatility calculation, as the options are priced relative to this forward price. The forward price $F_T$ is not simply the spot price compounded by the risk-free rate. For dividend-paying assets, it must account for the present value of all expected dividends $D_I that will be paid out before the option's expiration. Each dividend's present value is subtracted from the theoretical forward price. This adjustment ensures that the options are correctly valued against the future price of the asset, net of any cash distributions, providing a more accurate basis for implied volatility extraction. In conclusion, while the VIX-style methodology is elegant and powerful, its practical application demands meticulous attention to detail. From ensuring data quality in illiquid markets to correctly accounting for dividends and understanding the implications of discrete approximations, each step presents potential pitfalls. A truly robust implementation requires not just understanding the core formulas, but also appreciating these edge cases and mathematical nuances. Only then can we derive a truly reliable and insightful measure of market-implied volatility. Welcome back to Market Brain. In this section, we're going to put our theoretical knowledge into practice with a detailed walkthrough of student exercise 1. This exercise will solidify your understanding of how to calculate the forward price for an asset that pays dividends and, crucially, how to select the correct options contracts for a VIX-style implied volatility calculation. We'll break down each step, ensuring every concept is crystal clear. Let's begin by setting up our scenario. Imagine we are tasked with calculating a VIX-style implied volatility for a hypothetical asset. We are provided with its current spot price, a risk-free interest rate, and a schedule of expected dividend payments before our target option expiration. Our initial and critical step is to accurately determine the forward price for this asset, as it forms the bedrock for identifying the relevant options contracts. Recall from our previous discussions that the forward price for a dividend-paying asset is not simply the spot price compounded by the risk-free rate. We must account for the present value of all expected dividends that will be paid out before the option's expiration. Each dividend's present value is subtracted from the theoretical forward price of a non-dividend paying asset to arrive at the correct forward price. For our exercise, let's assume the following parameters. The current spot price of the asset, $S_T$, is 100 units. The risk-free rate, $R$, is 5% per annum. The time to option expiration, $T$, is 30 days, or approximately 0.0822 years. We anticipate two dividends, $D_1 of 0.50 units payable in 10 days, and $D_2 of 0.60 units payable in 20 days. These values are crucial for our forward price calculation. First, let's calculate the present value of each expected dividend. For $D_1 paid in 10 days, its present value is $D_1 discounted by $RT_1. Similarly, for $D_2 paid in 20 days, its present value is $D_2 discounted by $RT_2. Summing these present values gives us the total present value of dividends that will impact our forward price calculation. Now we can compute the forward price, $F_T$. We take the spot price, compound it by the risk-free rate over the time to expiration, and then subtract the total present value of the dividends we just calculated. This adjustment ensures that the forward price accurately reflects the asset's value at expiration, considering all cash flows during the period. This precise forward price is essential for the next steps in our VIX calculation. With our forward price, $F_T$, established at approximately 99.31, the next crucial step is to select the appropriate options contracts for our VIX calculation. The VIX methodology requires us to identify out-of-the-money, or OTM, calls and puts, along with the at-the-money, or ATM, strike price that is closest to our calculated forward price. This careful selection process is paramount for accurately capturing the market's implied volatility across a relevant range of strikes. Let's consider a hypothetical set of options data for our asset, all expiring in 30 days. We have various strike prices, along with their corresponding call and put bid and ask prices. For instance, we might have strikes ranging from 90 to 110, with their respective market quotes. Remember, for VIX calculation, we'll use the midpoint between the bid and ask for each option to represent its fair value. To find the option's fair value, we calculate the mid price for each. For example, a call's mid price is simply the average of its bid and ask. The VIX methodology then requires us to identify the strike price, $K_0, which is less than or equal to the forward price, $F_T$, and for which the absolute difference between the call and put mid prices is minimized. In our case, with $F_T approximate $99.31, the strike $K_0 equals $95 is the closest strike below $F_T$, and $K_0 equals $100 is the closest strike above $F_T$. The strike $K_0 equals $100 has the smallest difference between call and put mid prices, making it our ATM strike. Based on our forward price of approximately 99.31 and our identified ATM strike of 100, we select the out-of-the-money options. For puts, we include all strikes below 100. For calls, we include all strikes above 100. The VIX methodology specifically excludes in-the-money options to focus purely on the market's expectation of downside and upside volatility, as reflected by the OTM contracts. This ensures we capture the true breadth of market sentiment. With our selected options, we can now set up the initial summation for the VIX variance calculation. This formula aggregates the contributions of each out-of-the-money option, weighted by its mid-price, its strike price squared, and the interval between strikes. The final term adjusts for the difference between the forward price and the selected at-the-money strike, ensuring a precise measure of implied variance. This is the heart of the VIX calculation. This initial summation forms the core of our variance calculation. It systematically aggregates the contributions of various out-of-the-money options, each weighted by their strike prices and the interval between adjacent strikes. The final term in the formula provides a crucial adjustment, accounting for the precise difference between our calculated forward price and the chosen at-the-money strike. In our next section, we will meticulously delve into the precise calculation of each component, completing our VIX-style index and revealing the market's implied volatility. Welcome back, Market Brains. In this section, we're diving into student exercise 2, where we'll apply our knowledge to calculate a VIX-style implied volatility index for a hypothetical asset. This isn't just about plugging numbers, it's about understanding each step, from selecting the right options to interpolating the final volatility. We'll walk through the entire process, ensuring every component of the calculation is crystal clear. Think of it as building a financial Lego set, piece by piece, until we have a robust measure of expected market turbulence. Our objective for this exercise is to derive a 30-day forward-looking implied volatility for a given underlying asset, using its available options chain. This involves several critical stages, each building upon the last. We'll start by identifying the relevant option contracts, then pinpoint the forward price, and meticulously select the out-of-the-money options. Finally, we'll sum their contributions and interpolate to our target 30-day horizon. This systematic approach ensures accuracy and adherence to the VIX methodology. To successfully complete this exercise, we'll follow a precise sequence of steps. First, we must identify and select the appropriate options contracts from the market. Next, we'll accurately determine the forward price for the underlying asset. Following this, we'll carefully select only the out-of-the-money options that contribute to the variance calculation. Then, we'll sum their individual contributions to derive a preliminary variance. Finally, we'll interpolate these variances to achieve our target 30-day implied volatility. The first crucial step is to determine the forward price, $F$, for each expiry. This isn't simply the current spot price, but rather the strike price where the absolute difference between the call and put mid prices is minimized. Formally, we find the strike $K_0 where $C, K_0, P, K_0, is smallest. Once $K_0 is identified, the forward price $F$ is calculated using the formula $F equals K_0 plus E caret RT \times C K_0 P K_0 $. This adjustment accounts for the cost of carry and ensures our forward price is arbitrage free. Next, we need to select the appropriate options contracts. The VIX methodology requires us to use options from 2 consecutive expiries that bracket a 30-day period. We'll choose the nearest expiry with at least 8 days remaining, and the next expiry immediately following it. For each of these expiries, we'll gather a comprehensive set of out-of-the-money calls and puts. This careful selection ensures we capture a broad spectrum of market expectations across different strike prices and time horizons. With our options selected and forward price determined, we can now calculate the variance for each individual expiry. The core of the VIX calculation involves summing the contributions of all out-of-the-money options. For a single expiry, the variance, $sigma$2, is given by a summation that includes the mid price of each option, its strike price, and the interval between strikes. This formula effectively weights each option's contribution based on its market price and its position relative to other strikes, providing a comprehensive measure of expected price dispersion. A critical part of the summation is the precise selection of out-of-the-money options. For strikes below the forward price $F$, we use puts. For strikes above $F$, we use calls. The strike closest to, but not exceeding, the forward price $F$ is designated as $K_0, and we use both its call and put mid prices in the calculation, effectively treating it as the at-the-money option. This ensures a smooth transition and avoids double counting or omitting crucial information around the forward price. The $K term in the variance formula represents the interval between strike prices. For any given strike $K_I, $K_I is half the difference between the adjacent strike prices, $K_I plus 1, K_I1/$2. For the lowest and highest strikes in our selected range, $K is simply the difference between that strike and its only neighbor. This weighting ensures that options with wider strike intervals contribute proportionally more to the overall variance, reflecting their broader implied probability distribution. Once we've calculated the variance for both the nearest and next nearest expiries, we need to combine them to derive a single 30-day implied volatility. This is achieved through a linear interpolation process. We effectively blend the two variance values, weighting them by how close their respective time to expiries are to our target 30-day period. This interpolation is crucial because it standardizes the volatility measure, allowing for consistent comparison over time, regardless of the specific option expiry cycles. The final step involves the interpolation formula to arrive at the 30-day variance. Let $T_1 and $T_2 be the time to expiry for the nearest and next nearest options, respectively, and $sigma_1 and $sigma_2 be their calculated variances. The 30-day variance, $sigma_30 is then given by a weighted average. This formula ensures that the resulting volatility accurately reflects the market's expectation for a standardized 30-day period, bridging the gap between discrete option expiries. After all these meticulous calculations, we arrive at our VIX-style implied volatility index. This single number represents the market's expectation of the annualized 30-day volatility for our underlying asset. A higher value indicates greater expected price swings, while a lower value suggests a calmer outlook. It's a powerful tool for gauging market sentiment and risk, providing a forward-looking perspective that traditional historical volatility measures cannot offer. This exercise demonstrates the rigor and detail required to construct such a sophisticated financial metric. And with that, student exercise 2 is complete. You've now walked through the entire process of calculating a VIX-style implied volatility index for a generic asset, from the initial data selection to the final interpolation. This deep dive into the methodology equips you with a robust understanding of how these critical market indicators are constructed. Keep exploring, keep questioning, and keep building your market brain. We've journeyed deep into the mechanics of implied volatility, dissecting the VIX methodology to understand how the market prices future uncertainty. But the world of quantitative finance is constantly evolving, pushing the boundaries of mathematical application. This section isn't just a conclusion, it's a glimpse into the future, connecting our VIX-style calculations to some of the most exciting and cutting-edge research frontiers in modern quant finance. While the VIX provides a powerful, single-number summary of expected volatility, many financial phenomena are far more intricate, depending not just on current levels but on the entire history, or path, of prices and other market variables. This path dependency is a central theme in advanced quantitative modeling, driving the need for more sophisticated mathematical tools to capture its nuances. We're moving beyond simple point estimates to understanding the full trajectory of market behavior. Consider derivatives whose payoffs depend on the average price over a period, or trading strategies that react to specific sequences of price movements. These are inherently path-dependent. Furthermore, the explosion of high-frequency data demands methods that can robustly analyze and model irregular, noisy time series. Traditional models often struggle with these complexities, necessitating a shift towards more flexible, non-parametric approaches that don't impose rigid assumptions on market dynamics. Formally, a financial path can be thought of as a multi-dimensional stochastic process, $x_T$, where $T$ ranges from an initial time to a final time $T$. This path might include the underlying asset price $S_T$, its realized volatility $V_T$, interest rates, or even macroeconomic indicators. The key is that we are observing a continuous evolution, not just discrete snapshots. Understanding the properties of this entire trajectory is crucial for accurate modeling and prediction. To effectively capture and utilize the information embedded in these complex financial paths, mathematicians have developed powerful frameworks. One such area is rough path theory, which provides a rigorous way to define and analyze integrals with respect to highly irregular, non-differentiable paths, like those generated by stochastic processes in financial markets. It's a foundational theory for understanding and modeling systems driven by noise. At the heart of rough path theory lies the concept of the signature of a path. The signature, denoted $S_0T$, is an infinite sequence of iterated integrals of the path. Think of it as a complete, non-redundant summary of the path's shape, its twists and turns, and the order in which events occurred. It uniquely characterizes the path up to reparameterization, providing a powerful feature set for machine learning algorithms. The applications of signatures in finance are vast and growing. They can be used for non-parametric option pricing, where the signature of the underlying asset's path becomes an input to a pricing model, bypassing restrictive assumptions. Signatures are also excellent for modeling volatility surfaces, developing sophisticated algorithmic trading strategies that react to complex patterns, and providing robust feature engineering for machine learning models predicting returns or risk. Another fascinating frontier is sheaf theory, a branch of mathematics from algebraic topology. While signatures focus on summarizing individual paths, sheaves are about understanding how local pieces of information can be consistently glued together to form a coherent global structure. In finance, this means modeling how information, prices, or risks propagate and interact across different market segments, timescales, or interconnected financial entities. Imagine aggregating market data from various exchanges, each with its own local view, into a consistent global picture. Sheaves provide the mathematical framework for this. They can model interconnected financial networks, where the stocks of the sheaf represent local data or relationships, and the restriction maps ensure consistency as we move between different parts of the network. This allows for a more robust understanding of systemic risk and information flow. While both signatures and sheaves offer powerful tools for modern quant finance, their focus differs. Signatures excel at capturing the essence of individual paths, providing a rich, non-parametric representation for machine learning and path-dependent derivatives. Sheaves, on the other hand, are designed to understand the intricate relationships and consistency of information across different local domains, offering insights into network structures and global market coherence. They are complementary lenses for viewing market complexity. The VIX calculation, with its elegant reliance on option prices to infer future volatility, stands as a testament to the power of mathematical finance. Yet, it's just one point on a vast and expanding landscape. As markets become more complex and data-rich, the integration of advanced mathematical concepts like rough path theory and sheaf theory will become increasingly vital. These frontiers promise to unlock deeper insights into market behavior, risk, and the very fabric of financial information. From the practical calculation of implied volatility to the abstract elegance of topological data analysis, the journey through quantitative finance is one of continuous discovery. The tools we've explored, from basic option theory to these cutting-edge mathematical structures, empower us to better understand, model, and navigate the intricate world of financial markets. The evolution of quant research is relentless, always seeking new ways to quantify the unquantifiable. Welcome to the final act of our deep dive into implied volatility and the VIX. Over our journey, we've dissected complex financial instruments, explored rigorous mathematical frameworks, and built a profound understanding of how markets price future uncertainty. This section isn't just a recap, it's a synthesis, connecting all the dots we've meticulously placed. We'll consolidate our knowledge, reinforce the core principles, and then cast our gaze forward, hinting at the exciting frontiers that lie beyond the VIX. Our quest began with a fundamental challenge: how do we quantify market participants' expectations of future price movements? This isn't about looking backward at what has happened, but forward at what might happen. We learned that options contracts, with their inherent sensitivity to volatility, offer a unique window into this collective market sentiment. They are, in essence, a direct reflection of the market's fear gauge or excitement meter for a given asset. We started with foundational models like Black-Scholes, which provided a theoretical framework for pricing European options. Recall that the Black-Scholes formula, $C equals S_Tn, D_1, KE caret, RT, N, D_2, takes inputs like current stock price $S_T, strike $K, time to maturity $T, risk-free rate $R, and volatility $\sigma$. While powerful, we quickly realized that in practice, we often observe option prices and infer the implied volatility, rather than inputting a known volatility. This inversion is where the real magic begins. The VIX methodology, however, takes a different, more robust approach. Instead of relying on a single option and inverting a model, it aggregates information from a wide spectrum of out-of-the-money options across different strikes and maturities. This model-free approach is crucial because it doesn't assume a specific distribution for future price movements, making it less susceptible to model misspecification. It directly reflects the market's perception of future volatility, without the constraints of a single theoretical framework. The essence of the VIX calculation lies in its elegant summation of out-of-the-money call and put options. It's a weighted average of squared implied volatilities, derived from these options, across a continuum of strike prices. Conceptually, it approximates the expected variance of the underlying asset over a fixed 30-day period. The formula involves summing terms like $\frac, E caret, RT, T, \sum_I\frac, \delta K_I, caret 2, Q, K_I, $, where $Q, K_I, $, is the midpoint of the bid-ask spread for each option, effectively capturing the market's collective view of future price dispersion. A critical distinction we explored was between implied volatility and historical volatility. Historical volatility looks backward, measuring the standard deviation of past price returns. It's a factual record of what has occurred. Implied volatility, on the other hand, is forward-looking, representing the market's best guess of future volatility, derived from option prices. These two measures often diverge, with implied volatility typically higher than historical volatility due to a volatility risk premium that option sellers demand. The true power of the VIX methodology lies in its generalizability. While the original VIX focuses on a broad market index, the principles can be applied to virtually any optionable asset. This is precisely what the GitHub repository we've been exploring demonstrates, creating VIX-style implied volatility indices for individual stocks or ETFs. This allows us to gauge the market's expected volatility for specific companies or sectors, providing granular insights beyond just the overall market sentiment. It's a powerful tool for tailored risk assessment. So, what are the key takeaways from our comprehensive journey? First, understanding volatility is paramount in finance. Second, options are not just speculative instruments but powerful tools for extracting market expectations. Third, the VIX provides a robust, model-free measure of implied volatility, offering a unique perspective on future uncertainty. Finally, the methodology is adaptable, allowing for the creation of custom volatility indices for specific assets, opening up new avenues for analysis and risk management. But our exploration doesn't end here. The world of volatility modeling is vast and ever-evolving. Beyond the VIX, researchers are delving into stochastic volatility models, where volatility itself is a random process, and local volatility surfaces, which capture how implied volatility varies across different strikes and maturities. Modern quantitative finance also leverages machine learning to predict volatility and price complex derivatives, pushing the boundaries of what's possible. This journey has equipped you with a solid foundation to explore these exciting frontiers. Thank you for joining us on this rigorous exploration of implied volatility and the VIX. We hope you feel empowered with a deeper understanding of these critical financial concepts and the mathematical elegance behind them. We encourage you to explore the GitHub repository, experiment with the code, and continue your learning journey. The world of quantitative finance is rich with opportunities for those who dare to ask how and why. Keep learning, keep questioning, and keep building your market brain.